re-recording because I used the wrong microphone earlier and the sound quality wasn't very good. So we're back at it once again, reviewing the charts, reviewing the technicals, after somewhat of a break. Other things going on. Starting from scratch again. You know the drill. Dealing with our trading discipline, dealing with our over-leveraging, dealing with our impatience, dealing with all our trading sins in our trading soul. And we're back for another bloody good go. So, here's S&P Daily, and I'm short. I'm short in my very small account. This low was quite something down here in March. And then the move up, absolutely incredible. From the low at 63.10 to the recent high at 75.16. 1,200 points, or 20% rally. That's already very elevated prices. And I've seen calls for S&P 8,000, S&P 12,000, S&P 15,000. Before the whatever cycle concludes. I can't remember which cycle it was someone was referring to, but one of the longer term cycles, a 25-year cycle, something like that. But we have cause at the moment, at least, to be short. We have this negative divergence here on the momentum of price volume trend and on the histogram momentum of price on the daily, with a very long term weekly trend line going back here. We just sort of nudged up against it. I think it was weekly. No, it's a monthly. We're just nudging up against that, overshot slightly, and we're back under. We have this channeling action here. We broke out, we tested it once, tested it twice, and it looks like we've come down for a third time. We shouldn't really have done that. That's a lot of channel retesting. 4 hour, you see the more local, more short-term divergences, and you can see the rise up and then the drop down. We back tested again into the centre of this pivot area here, this resistance, all these dojis all lined up here. Then we've dropped down again a bit further. So we might be expecting that trend to continue, at least in the short term. Why? Well, good question. If we look at the dollar, we've got a big bounce in the dollar, and we can see we've gone nowhere for basically a year. This could be accumulation. We've got this wedging action here on the momentum, the price volume trend. We don't have an awful lot more to show for it on the RSI. We can't, I don't think we can draw anything similar in. Let's have a look. Can we draw anything similar in? I mean, a little bit. And there's our big candle up. But again, did this move up in the dollar cause a crash? No. Did this move up in the dollar cause a crash? No. These big moves up here that led to this doji and this wick here, we're only as high as we were a couple of weeks ago on the dollar. Was this causing a terrible crash a couple of weeks ago? No. So take that with a pinch of salt. That'll probably have more effect on metals. Interest rates though, quite substantially going up. So anyway, that's my price case for being short the S&P. Let's review the breadth case. So NIAD, double bottom, or slight positive divergence on the late March lows, histogram diverging, MACD cross, up we went, high, no matching high with price, just squeaked a new high here, but then no matching high. We have negative divergence, we're below the 20 period, MACD histogram is negative, and the line, the MACD line has crossed under as well. NIUD, similar story, significant divergence at the lows, unlike the little one back here, more significant divergence. No new pride though. The new high in price here, look, only came on the 17th of April. When the high in price, the new high in price, had been a couple of days before. There, I said price there, I meant the indicator. Here, no new high on the indicator with the new high in price, no all-time high. And then divergence 1, big divergence 2, and a big drop-off. So, somewhat bearish signals, the Nasdaq, new highs minus new lows. There's your March low, late March low. Nothing going on divergence-wise really, but then we're back over the zero line. We're buying. Sort of a negative divergence. We're losing momentum. Histogram's gone negative, and MACD line has crossed, and we're below the zero line. So that is bearish signals as well. This is selling bias signals. So you're looking down on whatever time frame you want, and then going down another time frame for your entry. Shorting. Shorting biased, bearish biased. Rinia, similar story. Inverted head and shoulders near the lows, the right shoulder with the absolute low in price, the head with the penultimate low, the left shoulder with a further distant prior low. So inverted head and shoulders forming at the March lows, rocket ship up and declining ever since, and now we are below 60, below 40. MACD crossed negatively at the line and the histogram. The bullish percent of the S&P, similar story. Small histogram divergence in the lows, rocket ship up, no new highs with price declining since the 21st of April and now below 60 and indeed below 50% on the bullish percent index. Now, weirdly, the SPX A50R, the percent of stocks above the 50-day moving average, gives different numbers than the bullish percentage of the SPX of the S&P 500, which is, they're supposed to be basically the same. Bullish percent measures what percent of stocks, I think, are over their 50-day moving average. But then again, this is supposed to do the same thing because it's the percent of stocks above the 50-day moving average, but we get different numbers. Look, we've got 49 here, with a recent high at 67%. Recent high here at 64%, now we're down to 44%. It's marginal differences, so why not have both? Different information, possibly useful information, who knows. Same story though, no new high, diverging, going under RMAs, MAs tilting down, MACD crossing negatively, you name it. Consumer discretionary ratio of against consumer staples. Head and shoulders distribution earlier in the year, loss going nowhere, then the tumble into February, March, there's the tumble, positive divergence at the lows, and we reached our peak in again 17th to the 21st of April. We've been diverging negatively ever since, we're under the 20, both moving averages tilting negatively, turning down, MACD histo below zero, MACD line negatively crossed. So, taken as a totality, I think we've got further evidence for a bearish take. This is what's been driving the rally. It's the move into technology stocks. It's the move into semiconductors. Look at the long-term chart of this and just imagine you spent the last 18 years, 16 years, whatever. No, 18 years. The last 18 years, my God. Just buying. Just wake up and buy. And I was just coming out of university back here. I had vague dreams of being a trader in my head, but didn't know the first thing about it. Graduated, was unemployed, worked for minimum wage, went back to university, was unemployed for 3 years, trained to be a teacher, still had no money. It was only really around COVID. Where's COVID? Here we go, 2020. So I've been trading on and off semi-seriously since... Where's COVID? Since in this time frame, you know, my dreams began here, and I was basically able to do absolutely sweet F all about it until COVID, when I finally had some money, some disposable income, and I shat the bed ever since, you know. But I had some pretty close calls. I nearly made a lot of money, or got the ball rolling at least. You know, my trading behaviour was on the spot, on point. We've broken out of this channel. I mean, look at this. I mean, wow. So if we're going to so in inner to inner, and outer to outer. And let's see if we're worth duplicating. Wow, okay. Well, absolutely extraordinary. Absolutely extraordinary. This is the only fly in the bear showing, which is the strength of semiconductors, but even then we've got some local divergences. Maybe it'll hold up better, maybe it'll crash more. Maybe this is just a blip. Usually is in stocks. It could just be a blip, but the point is, evidence says to be bearishly biased, at least for the short term. Crude. There's a monthly. What would be interesting with crude if we're going to see re-ranging? What I mean by that is the range of crude, look, from, as far as my chart goes back, 1983 to 2004, so a 20-year range, was from $9, $10 to $36, $35, $37. And that was a 10-year range. And then following that, we went from 2003 to 2020, look. 2022, 2023, something like that. About 20 years. Where the real range, where we spent most of our times and where most lows and most highs formed, were within $33 to $120, $110. Yeah? Well, obviously you get this big spike down here, this big spike down here, the COVID, somewhat aberrational. 20 years in this range, 20 years in this range. Can we break out? Can we break out? And can we then go on to have, 20 years in a range? If we break out, will we then have 20 years in a range like this? Maybe going up to... Well, you don't know. You don't know. The point is we putting this humongous double bottom here at the more or less midpoint of this old 20-year range. So if this is now the low of a new range, the old midpoint is the new low, the old high is the new midpoint, and then there'll be a high further up, and we would have a new range somewhere like that, where this would be the area where price was freakishly low, where price was at its midpoint, and where price was overbought, overpriced, and we'd have a new 20-year real range like that. That's my curious hypothesis. Yeah, I mean, a big box of pain, a big box of consolidation and chopping around. I suppose you've got no alternative but to be at least somewhat long biased. Do we have a head, a left shoulder, and a right shoulder? Ought we be breaking out? What would our target be? Let's have a look. It would be... Whoop, come here. Come here. Come here. Stop it. It's trying to auto-place itself to be helpful. Yeah, 140, 150. That would be interesting, wouldn't it? And we shall see. We shall see. Natural gas, again, wedging action, divergences, breakout, back test, up we go, head, left shoulder, right shoulder, strong close above this old rooftop here, these old highs, this old resistance becoming support potentially, and we'd see further upside if oil is going to go ballistic, if fossil fuels, if energy as a whole is going to go ballistic. Then if we're turning it around the mid-range of this long-term range, then a move towards the high of the range would seem potentially realistic, or otherwise we could come up to resistance at 3580, and then maybe we need to turn down and revisit the range lows back down here at 15, 16, 1700. But one would be presumptively long at the moment. But again, it's like, is now the best point to go long? Well, if you think it's going to hold, if you think these this sort of supports through here, this black line. Maybe a potential support. Do we have anything else to add on internals? Well, there's rates going ballistic. Bad for precious metals, bad for stocks potentially. So my main thing is I'm going to stick to my S&P shorts while the signals are to be biased that way, and we'll see how it all turns out.